You've watched gold surge past $5,000 per ounce in late January, only to see it pull back to $4,700 this week. You've seen silver hit $111 before crashing 40% to the low 70s. And if you're paying attention to the markets right now, you're probably asking yourself the same question every precious metals investor is asking. Why are Beijing and Washington locked in a trade war that is pushing tariffs to 145% on Chinese goods? Why has China reduced its U.S. Treasury holdings to $689 billion, the lowest level since 2008? And what does this have to do with the fact that your gold holdings are up over 200% since early 2025, while the U.S. national debt just crossed $38 trillion? These aren't coincidences. They're symptoms of a structural shift in how the world's two largest economies interact, and more importantly, how global capital is being redeployed away from traditional safe havens into hard assets. If you've been following this channel, you understand that we don't chase headlines or sell you on the idea that precious metals are going to make you rich overnight. What we focus on is the systematic breakdown of assumptions that most investors take for granted. And right now, one of those assumptions that U.S. Treasury bonds represent the safest store of value in the world is being tested in real time. Before we go further, if you're serious about understanding how geopolitical shifts affect your wealth, hit that subscribe button and turn on notifications. We're going to break down exactly what's happening between Trump's tariff threats and China's Treasury sell-off, and why this matters far more than the daily price swings in gold and silver. And if this analysis helps you see the bigger picture, hit the like button so more people can find this content. Let's start with the data, because that's where the story actually begins. According to the U.S. Department of the Treasury, China's holdings of U.S. government bonds fell to $688.7 billion in October 2025, down from $700.5 billion in September. This is the lowest level since November 2008, and it represents a decline of more than 47% from China's peak holdings of $1.32 trillion in November 2013. China has been a net seller of U.S. Treasuries for more than a decade, but the pace has accelerated sharply in 2025. Between February and October 2025 alone, China reduced its holdings by over $95 billion. This isn't panic selling. This is strategic reallocation. And it's happening at the exact same time that China has been accumulating gold for 13 consecutive months, bringing its official reserves to 74.12 million troy ounces, valued at $310.6 billion. Now let's layer in the tariff situation, because this is where the economic pressure becomes visible. In February 2025, President Trump imposed a 10% tariff on all Chinese imports, citing national security concerns related to fentanyl trafficking. By March, that tariff was raised to 20%. Then in April, as part of his so-called reciprocal tariff agenda, Trump escalated duties on Chinese goods to 145% after China retaliated with tariffs of its own. The effective tariff rate on Chinese goods now sits at 145% when you account for all the layered duties, while China has imposed 125% tariffs on U.S. goods. This is not a trade negotiation. This is a trade war, and it's fundamentally altering the flow of capital between the two countries. Here's why this matters to you as a precious metals investor. When China sells U.S. Treasuries, it's not just reducing exposure to dollar-denominated assets. It's converting those holdings into other stores of value, and gold is the primary beneficiary. The numbers bear this out. In the same period that China reduced Treasury holdings by nearly $100 billion, it increased gold reserves by approximately 30,000 troy ounces per month. That's not a hedge, that's a transition. Now, some analysts will tell you that China selling Treasuries doesn't matter because other buyers, primarily Japan and the United Kingdom, have stepped in to absorb the supply. And technically, that's correct. Japan increased its Treasury holdings from $1.189 trillion to $1.2 trillion in October. And the UK raised its holdings from $864.7 billion to $877.9 billion. But here's what that analysis misses. The composition of Treasury buyers has shifted dramatically over the past decade. Foreign governments, which used to hold Treasuries as a strategic reserve with less sensitivity to price, now represent a smaller share of total holders. Private investors, who are profit-driven and price-sensitive, now hold a much larger percentage. This means that Treasury yields must remain attractive relative to other fixed income options, or demand will dry up. And that's exactly what we saw in April 2025, when the 10-year Treasury yield spiked to 4.592%, the highest since February, after Trump announced his reciprocal tariff plan. The sell-off wasn't just China, it was a combination of Japanese life insurers rotating out of long-dated Treasuries, European pension funds reducing exposure, and hedge funds unwinding bond basis trades. The result was a rapid increase in yields, which means bond prices fell, which means investors lost money on what's supposed to be the safest asset in the world. Let me give you a concrete example of what this looks like in terms of opportunity cost. Let's say you held $100,000 in 10-year Treasury bonds in early April 2025. When yields spiked from around 4% to 4.6% in a matter of days, the value of your bond holdings dropped by approximately 4%, or $4,000. At the same time, gold was trading around $4,200 per ounce. If you had allocated that same $100,000 to gold at the start of the year, when it was trading around $2,800 per ounce, you would have held roughly 35.7 ounces. By late January, when gold hit its peak of $5,586 per ounce, those holdings would have been worth $199,000. Even after the recent pullback to $4,700, you'd still be sitting on $167,000. That's a 67% gain versus a 4% loss in Treasuries during the same period. Now, I'm not suggesting that everyone should dump their entire portfolio into gold. What I am showing you is the actual math behind asset allocation decisions during periods of geopolitical and fiscal stress. And the stress is real. The U.S. national debt now stands at $38.43 trillion as of early January 2026. It's growing at an average rate of $8.03 billion per day. Think about that. $8 billion per day. That's $334.48 million per hour, $5.57 million per minute, or $92,912 per second. The debt-to-GDP ratio has now surpassed 120%, and according to the Congressional Budget Office, it's projected to reach 150% within 3 decades. Interest payments alone hit $179 billion in the first quarter of fiscal year 2026, making it the second largest federal expenditure, narrowly beating both Medicare and national defense. The CBO estimates that by 2034, interest costs will reach $1.6 trillion annually, absorbing the equivalent of $1 in $4 collected in individual income taxes. This is fiscal dominance territory, and former Treasury Secretary Janet Yellen said exactly that at a panel hosted by the American Economic Association in early January. She warned that the preconditions for fiscal dominance are clearly strengthening, noting that debt is on a steep upward trajectory. Fiscal dominance is the point at which the Federal Reserve can no longer control inflation through interest rate policy, because raising rates increases the government as debt service costs so much that it becomes counterproductive. Imagine you're driving a car towing a $38 trillion trailer. If you hit the brakes too hard to slow down inflation, the weight of the trailer will cause the brake pads to explode, meaning the government's interest payments become unsustainable and default risk rises. So the Fed has to let off the brake, even if the car is speeding toward a cliff. This is the mechanism through which high debt constrains monetary policy, and it's exactly what China understands. Beijing isn't selling treasuries because it thinks the U.S. will default tomorrow. It's selling because it recognizes that the risk-adjusted return on holding dollar-denominated debt is declining relative to other stores of value, particularly gold. And this is where the Trump tariff strategy becomes relevant. The Trump administration has framed tariffs as a revenue-generating mechanism that could eventually replace income taxes, at least for those making less than $200,000 per year. The Tax Foundation called this idea mathematically impossible, and the data supports that assessment. Tariffs brought in approximately $200 billion in fiscal year 2025, roughly $125 billion more than the previous year. But in the same period, interest expense on the national debt grew from $881 billion to $952 billion. That extra $71 billion in interest costs offset nearly 60% of the gains from tariffs. In other words, the tariff revenue isn't even keeping pace with the growth in debt service costs, let alone generating enough to replace income taxes or meaningfully reduce the deficit. And this is before accounting for the economic drag that tariffs create. Higher import costs lead to higher consumer prices, which reduces purchasing power, which slows consumption, which reduces GDP growth. The Tax Foundation estimates that the tariffs imposed through 2025 amount to an average tax increase of $1,000 per U.S. household in 2025 and $1,300 in 2026. That's disposable income that's not being deployed into productive economic activity. Now let us talk about what China's doing with the capital it's freeing up by selling treasuries. As I mentioned earlier, gold accumulation is the primary visible allocation. But there's a broader strategic shift happening. China is reducing its dependency on the U.S. financial system across the board. This includes reducing exposure to dollar-denominated assets, diversifying its foreign exchange reserves, and building alternative payment systems that bypass the SWIFT network. The Belt and Road Initiative, which has been running for over a decade, is part of this strategy. By financing infrastructure projects across Asia, Africa, and Europe, China is creating economic dependencies that don't require dollar settlement. And increasingly, those transactions are being settled in yuan or in bilateral currency swaps. that avoid the dollar entirely. This is de-dollarization in practice, and it's accelerating. Global dollar reserves now sit at around 57 to 58%, the lowest level since the 1990s. At the same time, central bank gold holdings have doubled since 2014. What does this mean for your portfolio? It means that the historical assumption that U.S. Treasuries are the ultimate safe haven is being challenged not just by rhetoric, but by capital flows. When central banks, which manage trillions of dollars in reserves, start rotating out of Treasuries and into gold, that's not a tactical trade. That's a structural reallocation. And when that happens, the price of gold isn't driven by short-term sentiment or speculative positioning. It's driven by sustained demand from the largest, most patient buyers in the world. This is why gold hit $5,500 in late January, and why, even after a sharp correction, it's still trading above $4,700. The correction itself is instructive. Silver, which is far more volatile than gold due to its smaller market size and industrial demand component, dropped over 40% from its January peak of $111 to the low 70s in early February. Gold, by contrast, dropped roughly 15% from its peak. This divergence tells you something important about the nature of the rally. The silver rally was partially driven by a speculative positioning, particularly from Chinese traders, which added froth to the market and made it vulnerable to a sharp reversal. The gold rally, while also benefiting from speculative interest, has a much stronger foundation in central bank buying and structural demand from investors seeking alternatives to dollar-based assets. This is why gold tends to hold its gains better during corrections. It's also why allocating between 5 and 10% of a long-term portfolio to gold, as many advisors recommend, makes sense as a hedge rather than as a speculative bet. Now, let's address the elephant in the room, which is whether China is actually dumping treasuries in retaliation for U.S. tariffs, or whether the sell-off is driven by other factors. The evidence suggests it's a combination. Some analysts, including Prashant Nunaha at TD Securities, argue that if China were engaging in large-scale dumping, you'd see a steeper yield curve with front-end yields rising faster than long-end yields. Instead, what we saw in April was that 30-year yields climbed 48 basis points, while 5-year yields gained 36 basis points. This suggests that the selling pressure was more evenly distributed across the curve, which is consistent with a mix of sellers, including Japanese institutions, European pension funds, and hedge funds unwinding positions. But the broader trend is undeniable. China has been a net seller of treasuries for over a decade, and the pace accelerated significantly in 2025. Whether you call it dumping or a strategic reallocation doesn't change the outcome. Less Chinese demand for treasuries means that other buyers need to absorb the supply, and those buyers are more price sensitive, which puts upward pressure on yields and downward pressure on bond prices. This creates a feedback loop. Higher yields mean higher debt service costs for the U.S. government, which increases the deficit, which requires more borrowing, which puts more supply into the market, which pushes yields higher. And at some point, if this cycle continues, investors start demanding a higher risk premium to hold U.S. debt, which is exactly what Janet Yellen warned about. This is where the Trump administration's aggressive use of tariffs as a geopolitical tool becomes problematic. Tariffs are generating revenue, but they're also escalating tensions with the country that used to be the second largest holder of U.S. debt. And those tensions are accelerating China's shift away from dollar-based assets. In October 2025, Trump threatened to impose an additional 100% tariff on Chinese goods, pushing the effective rate to 155 to 157%, in response to China's export controls on rare earth minerals. This threat, which was later walked back after stock markets dropped sharply, illustrates the volatility and unpredictability of the current trade relationship. Markets hate uncertainty, and when you combine trade war escalation with rising debt levels and falling foreign demand for treasuries, you create an environment where traditional safe havens start to look less safe. This is the environment we're operating in right now. And it's why gold and silver, despite their recent volatility, continue to attract capital from investors who are looking for assets that aren't directly tied to the creditworthiness of any single government. Let me give you another concrete example to illustrate the compounding effect of these trends. Let's say you're a 50-year-old investor with a portfolio of $1 million allocated as 60% stocks, 30% bonds, and 10% cash. That's a fairly standard allocation for someone in their 50s. In a stable economic environment, the bond allocation provides ballast during stock market downturns and generates predictable income. But in the current environment, where bond yields are volatile and rising, debt levels create fiscal risk, that 30% allocation to bonds is exposed to both interest rate risk and credit risk. If Treasury yields rise another 50 basis points over the next 12 months, which is entirely plausible given the debt trajectory, your $300,000 bond allocation could lose another 3 to 4% in value, or $9,000 to $12,000. Meanwhile, if you had allocated even 5% of your portfolio to gold at the start of 2025, when it was trading around $2,800, that $50,000 position would now be worth approximately $83,000 at current prices. That's a $33,000 gain that would more than offset the losses in your bond portfolio. This isn't hindsight bias. This is recognizing the structural forces at play and positioning accordingly. Now, some people will argue that gold doesn't generate income, which is true. It doesn't pay a dividend or a coupon. But it also doesn't have counterparty risk. You're not relying on a government's ability to tax its citizens or control inflation to preserve the value of your holdings. And in an environment where the U.S. government is running deficits of $1.7 trillion per year and accumulating debt faster than GDP is growing, that lack of counterparty risk has value. It's also worth noting that the real return on Treasuries, after accounting for inflation, has been negative for much of the past several years. If a 10-year Treasury is yielding 4% and inflation is running at 3%, your real return is 1%. Gold, by contrast, doesn't have a nominal yield, but it has delivered real returns of 79.9% per year from 1971 to 2024. That's lower than the stock market's 10.7% average annual return over the same period, but it's achieved with far lower correlation to equities and with no credit risk. This is why gold is properly understood as a store of value rather than as a growth investment. It's not competing with stocks. It's competing with bonds and cash as a safe asset. And in that comparison, the recent performance speaks for itself. Let's shift gears and talk about what comes next. The Trump administration has announced framework agreements with several trading partners, including the UK, to reduce tariffs in exchange for various concessions. With China, there have been multiple rounds of negotiations, including a 90-day tariff truce announced in June 2025 that reduced the tariff on Chinese goods from 125% to 30%. But that truce is temporary, and the underlying issues, particularly around rare earth minerals and technology exports, remain unresolved. China controls about 60% of rare earth mining and more than 90% of refining worldwide. And the US is dependent on China for roughly 70% of its rare earth imports. These minerals are critical for manufacturing magnets used in everything from electric vehicles to semiconductor production to weapons platforms. When China imposed export controls on rare earths in October 2025, it wasn't just a trade retaliation, it was a demonstration of leverage over a critical supply chain. Trump's response, threatening a 100% tariff, was a signal that the U.S. is willing to escalate economically, even if it risks further market volatility. But here's the problem. Economic escalation has costs, and those costs are borne by consumers, businesses, and investors in the form of higher prices, supply chain disruptions, and market uncertainty. And the longer this dynamic persists, the more investors will look for assets that aren't directly exposed to the U.S.-China relationship. Gold and silver fit that profile. They're globally traded, they're not tied to any single country's fiscal policy, and they benefit from the same uncertainty that creates risk in other asset classes. This is why both metals surged in January as trade tensions escalated, and why they've held a significant portion of those gains even after the recent correction. Now, let's address the question that's probably on your mind. Should you be buying gold and silver right now, or should you wait for prices to fall further? The honest answer is that no one knows where prices will be in the short term. Silver could easily drop another 10 or 15% if speculative positioning continues to unwind. Gold could pull back to $4,200 or even $4,000 if there's a temporary trade deal that calms markets. But if you're thinking in terms of a 3 to 5 year horizon, the structural factors I've outlined, rising U.S. debt, falling foreign demand for treasuries, central bank gold accumulation, and ongoing geopolitical tensions are unlikely to reverse. And that means the case for holding precious metals as a portfolio hedge remains intact. The key is to think about allocation in terms of risk management rather than speculation. If you're currently holding 0% in precious metals and 100% in traditional stocks and bonds, you're fully exposed to the risks we've been discussing. If you allocate 5 to 10% to gold, you're not betting that gold will outperform everything else. You're acknowledging that there are structural risks in the financial system that traditional diversification does not fully address. And if those risks materialize, whether through higher inflation, currency debasement, or fiscal crisis, that 5 to 10% allocation could preserve purchasing power in a way that bonds and cash won't. Let me give you one final example to bring this home. In 1971, when the U.S. went off the gold standard, the national debt was around $400 billion. Today, it's 95 times larger. In that same period, the price of gold has gone from $35 per ounce to over $4,700 per ounce. That's a 134-fold increase. This isn't a coincidence. Gold's price in fiat currency terms is a reflection of the cumulative debasement of that currency over time. And while past performance doesn't guarantee future results, the current trajectory of U.S. debt growth suggests that debasement will continue. Every $1 trillion of additional debt, every year of deficit spending, every instance where the government chooses to inflate away its obligations rather than raise taxes or cut spending, reinforces the case for holding assets that can't be printed. This is the core insight that separates investors who understand monetary policy from those who don't. Money is a claim on future productivity. When a government issues more claims than its economy can support, the value of each claim declines. Gold, by contrast, is a finite resource. You can't print it, you can't borrow it into existence, and you can't legislate its supply. This is why it has served as a store of value for thousands of years, and why it will continue to do so, regardless of what happens in Washington or Beijing. Now, as we wrap up, I want to be clear about what I'm not saying. I'm not saying that the US is on the verge of collapse. I'm not saying that you should panic, sell your stocks, or go all in on gold. And I'm not saying that China's Treasury sell-off by itself is going to crash the dollar. What I am saying is that the assumptions underpinning the traditional portfolio, that bonds are safe, that the dollar is unshakable, that US debt levels are manageable, are being tested in real time. And the data, from Treasury sell-offs to gold accumulation to rising yields, suggests that the world's largest investors are adjusting their behavior accordingly. If you've been watching gold and silver prices fluctuate over the past few months and wondering whether you should be doing something different with your portfolio, the answer is probably yes. Not because you're trying to time the market or chase returns, but because the financial landscape has changed in ways that most conventional advice doesn't account for. The relationship between the US and China is more adversarial than it's been in decades. US debt is growing faster than the economy. Foreign buyers are reducing their treasury holdings. Central banks are accumulating gold. And precious metals, despite their volatility, are outperforming bonds and holding their value better than most people expected. These aren't short-term trends. These are structural shifts that will play out over years, not months. And positioning for them doesn't require perfect timing. It requires understanding the forces at work and allocating capital in a way that reflects that understanding. So here's what I want you to take away from this. Trump's tariff threats and China's Treasury sell-off aren't just headlines. They are symptoms of a global reordering of capital flows that has profound implications for how you should think about wealth preservation. Gold and silver aren't magic. They won't make you rich overnight, and they won't eliminate risk from your portfolio. But they do offer something that bonds and cash increasingly can't: protection against the systematic erosion of purchasing power that occurs when governments accumulate debt faster than their economies can support. If you found this analysis valuable, I want to hear from you. Drop a comment below and let me know what you think about China's Treasury sell-off and whether you are adjusting your portfolio in response. Are you holding more gold and silver than you were a year ago, or are you staying fully allocated to traditional assets? And if you have questions about how to think about precious metals allocation or any other aspect of this analysis, leave those in the comments as well. This is exactly the kind of conversation we need to be having, because the mainstream financial media isn't going to give you this perspective. Before you go, make sure you are subscribed to this channel and hit that bell icon so you don't miss future breakdowns. We're going to continue tracking these trends as they develop, and the next few months are going to be critical. And if you haven't already, hit the like button to help this content reach more people who need to understand what's really happening in the markets. Thanks for watching, and I'll see you in the next one.